Baby shark, baby shark, baby shark, baby shark, mommy shark, mommy shark, mommy shark, mommy shark, daddy shark.
Dang it, Brent. Welcome back to the Real Investment Show.
Here's your earworm for the morning.
Oh man, I hate that you just did that. You know, I've got a couple things with that, right? One, got the little dude at home who sings it all the time. Then it brings you back to Astros memories of the Nationals. Wasn't very good memory there. Dang it. Just put me in the dumps here for the rest of the show.
I'll go out and exercise.
All right, I'll be back. So we talk a lot about what other financial pundits say that they do right and potentially wrong. And, you know, one of them who we sometimes give a little bit of a hard time is Dave Ramsey. And while Dave, I think he does get a lot of things very right, the majority of our clients have actually graduated from Financial Peace University. They've done very well. They've saved funds. They're at a point in life now where they need a little bit more sophisticated planning and investing. And that's great. I think Dave serves a big portion of the population. He does a fantastic job. I love what he stands for, what he does. But he has some things where he's very right, but others that he's just way wrong. One thing I don't think he's very good at is actual true financial planning or investment advice. And I know I'm going to get a lot of grief for this. Wrote an article on this actually last week in our financial planning corner. We spent some time on, you know, what he has right and what he has wrong about like permanent life insurance. And we talked about it more frequently on the show. If you guys have been listening, you'll know that it's a big deal, especially with the new Secure Act and trying to keep money in your pocket. Also, with the tax situation that we're currently in, we want to find other ways to keep more money in your pocket because we do believe with the deficit spending that's going on and it has been going on for, you know, over a decade, it's likely going to be that we're going to face higher taxes someday. So what are the tools, where areas, you know, quote unquote loopholes that we can find to put funds in that give us more flexibility? And I think this is really important right now with where we are. So, you know, Dave's overall philosophy is, look, you need to buy term life insurance and invest the rest. So essentially, if, you know, in theory, it sounds really good. You know, and I think that's great. What happens with a lot of people is they don't have the ability to actually go out and save. If it's in their account, they're going to spend it. So I do think that buying a term policy is great. And that's actually where you should start when we're talking about life insurance. Everybody needs a term policy because most people aren't going to be able to utilize a permanent policy for what it's really worth and being able to functionally fund it on a regular basis. So for the average Joe, for anybody, and I don't care for anybody, you need, from a risk management mindset, you need a term policy, and you need one now if you don't have one. Now, there's going to become a time if you're driving in the car and you say, man, I'm 60, the kids are out of the house. Yeah, well, maybe you're self-insured. You may not need one then, but especially if you're younger, you need to start thinking about this, right? Because this is going to be where you start considering, okay, do you have any debt? What is loss of income? What's the overall impact? What if, you know, what are your expenses? How many kids do you have? You're going to send them to school. What type of lifestyle would you like to maintain? How old are you? Do you have insurance through work? Is it portable? If you leave your job, can you take it with you? You know, the rule of thumb typically says you want 7 to 10 times your annual salary. We believe that, you know, it needs to be very intimate. This is very customizable, and that each person needs to figure out exactly what they need based on all those factors. So could be much less, could be much more. We're seeing people who are living leaner and leaner. And so I think that's a great thing. So what Dave says, in the sense that getting a term policy, invest the rest, I love it. I think it's great. But now what Dave does is he takes it one step further and says that, you know, permanent life insurance is terrible. I don't actually find that to be true. Right now, we're in an environment, and I just kind of laid the groundwork in the sense that we have deficit spending. We have a lower tax bracket. We have a lot of things that are in our favor at the moment. Well, deficit spending may not be, but we have some things that are in our favor. One thing I do hear from people that are looking to put funds away, and I hear from on a regular basis, says, look, I make too much to put money into a Roth IRA. I hear this as well. I make too much to put money into a Roth 401k. And in fact, there are no income limitations on that Roth 401k. So do keep that in mind. You can contribute. You should contribute. I also hear that, well, I'm going to retire in a much lower tax bracket. So maybe I don't need to fund the Roth. I don't want to pay taxes now. Because look, I get it. Nobody I talk to wants to pay taxes right now. So this is something that's a little bit counterintuitive. It's difficult to do, to think, okay, I'm going to pay taxes, put it in these Roth accounts, then have the flexibility to take out later. I also hear, hey, I can't make tax deductible IRA contributions. I hear, where do I put funds right now? Savings rates are extremely low. I'm having a difficult time finding areas to invest. Right now, that's right, they are low. But don't have that FOMO. Don't have fear of missing out, which I know is very real. Find a high yield savings account. Alternatively, I also hear markets are just too high to put funds to work. The risk is there. And so, look, the list goes on and on and on. One thing the financial industry's really beat into our brains essentially is that we must have tax deferred savings. We need it. We need it now. I have maybe a conspiracy theory about that they want you to put more funds in, not less. Hence, you pay taxes. You potentially put less funds into your 401ks, your retirement accounts, because you're taking that money and sending it off to Uncle Sam. And hey, these guys are getting paid off the assets, right? So do need to be considerate there. How do you prepare for these higher taxes? So we're in an environment right now where we don't always see people retire in much lower tax bracket. We start backing out, your 401k contributions, your health expenses. We start backing out your other pre-tax things. Then, not to mention if you have any savings. So many times your tax bracket is not all that smaller than where you are today. Well, we talk about it, and one way I want you to kind of maybe conceptualize this is think of a three-legged stool. We have three different legs here. One is fully taxable. Leg 2 is partially taxable. Leg 3 is going to be tax-free. So now if you could put all of your money into one place and we could have these funds grow, we typically would want the tax-free leg, and we want to fill that thing up. Unfortunately, this stool's pretty wobbly because we do a really good job with one fully taxable. That's going to be because every dollar you take out of this, that's your IRA, your 401k, any tax deferred accounts, that's going to be fully taxable down the road. Once you take those funds out, you lose control. And so one way I like to think of these accounts is that you own a business and you own it with Uncle Sam. And essentially, this is very unique in the sense that they can go out and they can raise their ownership percentage at any given time. That's huge. So you may think you have X amount of dollars, but it may be way less depending on what the government decides to do with taxes down the road. So that leg 1, that fully taxable leg, is typically the strongest, the biggest, but it's not probably where we need to put all these funds. So leg 2, that partially taxable, that's going to be your checking, your savings, brokerage accounts, and just your regular investment, individual, joint, funds that you're going to pay taxes on when you sell something or you have interest or dividends. But then leg 3 is that tax-free leg. And that's going to be your Roths. That's your Roth IRA, Roth 401k, or cash value from permanent life insurance. So this cash value, let's talk about that. How do you accumulate it? And here's where I think Dave's right, because when utilizing a permanent life insurance policy, this must be done properly. And I mean, you could screw this up very easily. There's a lot of things that we want to make sure that are done right. And this is one of them. Because unfortunately, you get these policies, you typically don't understand or know that you've done the wrong thing until you're way down the road and it's too late. You either can't go get a new policy, you don't qualify for the insurance, or you've just been in it for years and time is not on your side. So when we do a permanent life insurance, we're not necessarily doing it we're not purchasing a product like this typically for the death benefit, unless, one caveat, you have an estate issue and you have potential estate taxes, which we could see that come back very easily where they lower the estate taxes once again. And in that environment, it would be something that many people will need these policies for a death benefit. And there's lots of ways we can accomplish this. But for the purposes of what we're talking about right now, it's very important to know that when you buy one of these policies, you typically want the death benefit to be lower and you want to overfund it. But you can only overfund it to a certain amount. But you want to do this on a regular basis as to offset the expenses of a policy, have the funds set aside, and that way you can actually start accumulating cash value. So there's a couple ways. There's some that we really like, some that we really don't. We're not big fans of typically VULs, variable universal life insurance policies, probably like indexed or fixed index universal life, where it's going to be a fixed rate, or you're going to be tied to an actual index. You're going to have a little bit of participation on the upside, but you typically have no downside risk other than the expenses that are constantly ongoing inside these accounts, which is something we will get to as far as what those look like. But then whole life is another great alternative here. But the idea is You want to be able to put these funds aside. You want to invest these funds so that you have an area that you can withdraw from. And we'll get to that on the other side of the break on how you do that to make sure that you can avoid taxes. So you're listening to The Real Investment Show with Danny Ratliff. We'll be right back after this quick break. Talk a little bit more about what Dave Ramsey has right and wrong about life insurance.
Tommy used to work on the docks. Union's been on strike. He's down on his luck. It's tough.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
I want to finish up talking about what Dave Ramsey has right and wrong about permanent life insurance. So today, really just kind of covering the basics here, so trying to get an understanding of why we look at some of these types of things and where do they fit. And they don't fit for everybody, but I do think if you're looking at a plan to say, okay, I need to find a way to make tax-free distributions in retirement. I need to have some more flexibility to limit what I must take out from my required minimum distributions, which we're aggressively looking to make Roth conversions to shift funds away from these accounts that typically don't give us as much flexibility down the road. And so I think that this is a very integral part of it when used properly. So this has to be done right, like I said. So Dave's thoughts are that, everybody needs to buy term life insurance and you invest the rest. And, I think for most people out there, that is probably the case. But I do think there's a large percentage of the population who take that too far to heart, because these can be used properly when used right. These are great, especially when you think about, okay, I can't put funds into a Roth, or I don't have a Roth 401k, or I can't make tax deductible contributions, which that may not be the worst thing. All right, it means you're making good money. You're thinking about, where do I put additional savings? Where do I put additional funds? This could be the place. And I say could because it's not always going to be the case. You also have to be in decent health. You got to be able to qualify for something like this. We also want to make sure that the risk management aspect typically is already tied up, or this may be a portion of that as well. But we want to be able to overfund these types of policies in order to actually really accelerate that cash value, really grow that over time. And I think that's what the important part is. This is why it's not necessarily the best thing for everybody, because you have to make a commitment that you can do this. And I think that once you make that commitment and you see the growth in policies like this, and you can see that this is going to be something that down the road is going to give you that flexibility, this is a really good thing. And so I'm not going to go too far into the weeds on these today, but I really just want you guys to understand the concept that this could be good. And in fact, go to realinvestmentadvice.com, go to the financial planning corner from last week. You'll be able to see it. This week, we're going to get the details of all the different types. How do you pull withdrawals from here to keep it tax-free? Do keep that in mind. Go to realinvestmentadvice.com. Lots of information out there. If you have not already, go sign up for Lance's newsletter. Going to give you a ton of real good data, lots of information on what's going on a weekly basis, and what we're doing managing money here, how we manage portfolios. I think this is, if you ever wonder what we do or how we do it, this is a really good glimpse into exactly what happens at RIA Advisors. And so in 2 weeks, we're doing our next Right Lane class. It's going to be in Katy. Go sign up, realinvestmentadvice.com. Go to the events tab. We'd love to have you out. We're going to talk about all the things that are going on right now. The Secure Act, how does that impact you? That actually impacts, potential life insurance, potential RMD distributions, and inheritance from IRAs. Has some other positive and negative connotations, but we do cover some of those things. We're going to cover retirement planning. What type of assumptions should you be using? I think this is huge. We also get into long-term care, housing and retirement, investing in late-stage cycles, Medicare. Medicare is huge. Social Security, making sure that you're taking these right, you're not leaving anything on the table, or you don't have surcharges. Lots of stealth taxes out there. So this is why we're looking to actively put funds in areas that give you more flexibility in retirement, that don't cause you taxes, because we want to keep that money in your pocket, not put it in Uncle Sam's. So sign up, realinvestmentadvice.com. Go to events tab. You're going to be a great event. It's going to be on February 29th in Katy. So we'd love to see you guys there.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertshow.com.